Good morning, friends. This is Rajiv Gupta, Certified Financial Planner and Retirement Expert, talking to you today on very important topic. Friends, today we are going to discuss about lifelong pension and how you can achieve it. One of my client has recently purchased a product called UMANG, which he bought from a very reputed financial institution. And the thing is that when I came to know and when we discussed about it, so we came to know there are a lot of disadvantages associated with that product. And this client was just not the right person when he thinks that this product is going to be beneficial for him. So I thought that it is my duty and I must share you, the key features which are, not highlighted in the plan, which are not told by advisors and agents. But as an advisor, but as a responsible customer, you must have this, these features being highlighted, because otherwise what it can happen, it can create a lot of problems in your retirement. So today what we are going to discuss, that what should be an ideal retirement plan, how this so-called product UMANG doesn't fit in there on features wise. It may be a good product, but it is certainly not a good product for retirement. Why it is not there? These points we will be discussing today in this presentation. My request to you is please stick to this presentation. You will get a lot of financial nuggets in it and very, very important and useful information, which are very difficult to, decipher normally. So coming straight to that particular product, and when this customer bought it, he was told that this product is going to be, boom for his retirement, and he will be having very nice time and everything. But when I shared all these details with him, he was flabbergasted. He said that I am really totally, missold, and I'm not happy. Okay, I have already purchased it, but this product has got a lot of things which are not highlighted by the advisors who sells them or pushes them. So coming back to that plan, we'll go to that, and then we will also see what are the better options, how we can go about them. So coming to UMANG, it is certainly not a pension plan. It is sold as a pension plan, but actually it is a 100% non-pension plan. It is actually a combination of whole life and money back product. It is type of an endowment product. So endowment product, which is whole life and money back product, these two, it is a combination of that, and it is sold as a pension plan. And once the premium term is over, it becomes annuity product with fixed annuity paid for life and return of purchase price to nominee once annuity holder dies. So only difference is that the purchase price keeps on increasing with the period of time, but it is certainly not a product which can be ideally described as a pension. So this is the myth. It is not a pension plan. It is a money back and whole life combination. Second thing, the very important reason why my client bought this product, he was told that it has got 8% guaranteed return. But actually it is 8% guaranteed on sum assured, which remains fixed throughout the term. Whereas your corpus increases every year, which actually means the policyholders are robbed of real gains as the time progresses and paid lower amount every year. So we will see in the presentation if there is a 6% return on your fund value if you are investing for 15 years. So on 16th year, the fund accumulates whatever the amount value, you are getting just 3.8% of that fund value, and with that keeps on decreasing. We'll see in the future slides. And it goes down to just 0.8% of the total fund value after 40 to 50 years. So, any product which is giving you just 1% of your accumulation, how can you call it as a good investment product? And 99% is going to be given to your beneficiary, your nominee. So, but the concept of pension is that I'm saving for myself. I'm saving for my spouse and myself. I mean, we two have to be taken care for next 20, 25 or 30 years. Now, this is again a very important feature of this plan, that the very high value of sum assured is given on death. Now, what is the point? When you're talking about pension, what is pension? Pension is a provision for living too long. What is insurance? Insurance is when you are dying too early. So both these two things doesn't mix and match. I mean, this is just like that you are putting shampoo and conditioner in one thing, whereas shampoo has got a different purpose and conditioner has got altogether different purpose. When you mix both of them, both loses their unique features. So, I mean, and once the person crosses 60 or 70 years, the kind of mortality he has to pay for the company for his insurance, and that too on increasing value. I mean, it is quite difficult, and that money he would have used it for his day-to-day purpose. So, I mean, if you are planning for your old age, please keep insurance separately. Don't mix it. And if you are mixing, then you are compromising on the returns. As simple as that. Myth number 4, insurance cover increases every year without any cost. Actually, nothing in this world is free of cost. Here also, your accumulated fund value, we will see that out of 31 lakhs, if the 6% growth rate, you are paid only 1,20,000 on 1,20,000 rupees yearly premium. So what they do, when the next year the 6% accumulation happens, they deduct a part of it and they give you a rider term plan on the base plan. So this also has got a charge to it. It decreases from your fund value. So now these are not reversible. So longer you live, these fund charges will keep on deducting from your fund value. So I mean, this doesn't make sense for a person who is living on very tough budget. He has to survive on daily basis, but at the same time he's paying for his mortality, and that too increasing every year. Myth number 5, regular income is their income. Actually, this is not a right thing, because if you see, the income is dwindling income, which keeps on decreasing with the passage of time. Now inflation is 7%. Now what is the point in getting just 3.8% return on your fund value, and that too keep on decreasing every year? So on one hand, inflation is rising, and on other hand, your payout is decreasing. So in my opinion, this payout will be just enough to buy peanuts, not to maintain the lifestyle when you retire. Please understand. Myth number 6, everything in UMANG is guaranteed. Sorry, sir, it is not. It is guaranteed, the guaranteed amount is very small percentage. It is just 3.8% is the guaranteed. I mean, 8% on the sum assured, is the 3.8% of the fund value is the guaranteed of the first year. Now, the other bonuses, survival bonus and final addiction bonuses, are just not guaranteed. And they will be added every year depending upon the experience of the company, depending upon how much claims are there, how much money they have made in the markets, and based on that, how much payment they have to do to shareholder. Now, as you know, that if the shareholder previously they were sharing 95% of the fund value, life fund, with policyholders. Now, once the company goes public, then the fund value will be shared only 90%. So there is going to be huge drop. Now, all the illustrations which are shown by majority of agents are imaginary and fictitious in nature. They all are generated by a software, and they are not supported by the company officially. And so be very careful whenever you see any illustration which is made on software. You should always ask for the company official presentation. And we have tried to get that official presentation. We could not get from the website as per the IRD norms of 4% and 8%. Myth number 7, UMANG is a good pension plan even for 30 or 40-year-old person. No, UMANG or any other traditional plan has a zero component of equity, which is a disaster for a young age person who can take volatility and benefit from the power of compounding associated with equity. So equity is not dangerous at all. If the person is 30, 40 years, and if he has got a 30 years of horizon of investment horizon, he can definitely take some calculated risk, and he can park money in that mutual funds or on ETF, and that definitely is going to get rewarded. We will see that how that particular combination happens. But the biggest drawback is that no pension plan should have kind of lock into your capital. Even NPS allows 1/3 of fund can be taken as lump sum, which is the national pension scheme, which is given by the government, that allows that whatever accumulation of the fund has happened, 1/3 you can withdraw tax free. Now here the problem is that you will never get your amount. Forget about 1/3, even 10% of that. Lump sum is totally missing. If you want it, you have to break the policy, and there will be a lot of surrender charges, or the policy value will get deteriorated. So there is no point. You can take loan, but what is the point in taking loan when you cannot service that loan? How will you service it? It will be getting deducted from your policy growth only. So there is a lot of compromise. So actually what you are doing is you are accumulating your money which you need for a retirement for your next generation. So equity is the myth number 8 is equity is risky and debt is safe. This is the biggest lie. I mean, we don't know. Being a certified financial planner, I can tell you that long-term debt is most dangerous. Suppose the interest rate rises. For example, we have already seen that Fed has started raising interest rate. They have said in the commentary that they're going to raise by 1.5%. The global money, which was cheap till date, now they have started, because inflation is so high, they are going to raise the rates. And believe me, India is a fiscal deficit country. We have to import 80% of our oil. We have to treat it in dollars. So once the inflation is there in US, we are definitely going to import it, and you have to have at least 6 to 7% of inflation. So how will you beat inflation? Interest rates are going to rise. Any day RBI can raise the interest rates. Once the interest rates are raised, all banks, all financial institutions which have taken long-term sovereign papers are going to take mark-to-market hit of several thousand crores. Please note it. Long-term bonds are the worst performer once interest rate rises. I have seen a situation where, bond fund has given minus 25% return also. And it is not, just 10 years back when RBI raised the rates, all the bond market collapsed. So this, believe me, or if you are buying a product which has got long-term debt paper in that, so that is equally risky. But in equity, you have got power of compounding with you. So when you have got power of compounding with you, even the 40% doesn't perform, the equity performs, you can make very good money out of that. So there is another myth that fixed amount will be adequate for me. So it is just like an ostrich who is trying to hide his head in the sand when the storm is brewing. Fixed amount for 20-25 years is peanuts. It is going to be pathetic returns. What will you do when you need fund in your golden years for any emergency? There is no plan available. So if you have parked money in which the money cannot be withdrawn, and you are going to get just hardly a couple of percentage point, you are going to suffer very badly in the retirement. So why we are talking about that? Because we have seen what are the problems of a retired person and how he can manage that retirement with a decent planning, that we are going to see. So same fixed amount which keeps on coming is not right thing. Now this is an illustration which the agent gave to my customer on 1,20,000 15 years payment. 16th year onwards, you can see that 1,20,000 is coming continuously. Now this is 3.8% of the accumulated fund value, which keeps on decreasing with every passing year. And for example, when the person reaches 80 years of age, or probably 90, whatever his age may, after 50 years of investments, he is still getting 1,20,000 rupees, which is 1.3% of fund value, and 95 lakh rupees will be paid to the nominee or the beneficiary of the person. Now, this is a very, very gross injustice. Person who has saved for his golden years, why he should be deprived of his savings? This is my whole point about it. Now, coming to the inflation. Now, you know that inflation is very, very high right now. Every day, petrol prices is increasing every day. Any commodity you talk about, whether it is steel, whether it is cement, whether it is tea, coffee, sugar, plastics, everything has become dearer by more than 20% from last 1 year basis. And after this Ukraine-Russia war, we are seeing that inflation is raising its ugly head quite severely, and we don't know what is the peak of inflation. So how inflation, how inflation is dangerous for your income. This is just an example. If you have saved 1 lakh rupees in 1990, today its value is hardly 15,000 rupees. So after 30 years, if you are getting 1,20,000 rupees from a plan, actually its value is hardly 20,000 rupees. So just imagine if your expenses is 1 lakh rupees and what you will do with 20,000 rupees. So that is a big question. So it is extremely naive and childish if you plan your retirement with meager 4% return product like UMANG or for any other, for that reason, any traditional product, when inflation is 7%. Now this is dollar Indian rupee chart, and this I have made for one of the client who also bought the similar kind of product. He is an NRI. Now, when you see the dollar is appreciating 5% for the last 10 years, and if your return is 4.5%, so actually you are getting zero return on your investments. So what you have, what is the solution? I mean, why you are parking your product when the long-term trend is against that particular investment? Rupee is getting weaker and weaker from every passing year. When 10 years back, it was approximately how much? 45 rupees. Today it has 76, 77 rupees. So, I mean, absolutely no point in parking money over there. Now, if you can see this graph, this graph tells the whole story. If you can read this graph, if you can understand this graph, my purpose of presentation is solved. Pension should be like this, that the blue line, it keeps on increasing with every passing year. Suppose, for example, on 16th year, if you are getting 1,20,000, next year you should get 1,32,000, then next year 1,45,000. This should be, and what is you are getting in UMANG is the simple straight line. Now, who will fill this gap? Inflation is going to make everything costly and dearer. So how will you fill this gap? You are just making provision for this much amount. Who will pay for this much amount? So, I mean, this is what we are talking about. You see, in the same plan, we are seeing that when the person is reaching 50 years of age, at least 30 lakhs rupees will be needed by 7% inflation. So when the requirement after 50 years is 30 lakh rupees per month, if you are needing 1,20,000 going by 7% rate, so how will you manage with just 1,20,000? So now this was the problem, and these are the various disadvantages. I'm not against any product, but this product is not right for retirement, because retirement you need money. I mean, when there is a saying, when the silver is in your hair, gold should be in your pocket. Now, how to get lifelong pension till 80 years? So now we have deliberated upon that from last many years, and from last 10 years we have been working on what is the best solution where you can get the decent kind of returns. So what we found, that asset allocation is the right answer. If you are putting your money in 60% equity and 40% debt, I mean, this kind of asset allocation will beat any kind of return given by UMANG, or for example, for that reason, any traditional product, hands down, because the power of compounding comes to your side. So from last 22 years, we have a data, we have studied on the data, and we found that the 60-40 ratio is the best thing if you are planning for retirement. It takes care of almost everything. And only thing is that you have to do continuously rebalancing. This is what is rebalancing. We'll see in the next slide. So asset allocation is the key. If you go through various literature which is available on personal finance, nowhere it is talked about that any product gives you real solution or real moksha in the financial world. It is your asset allocation. Your asset allocation should always be in tune with your risk appetite, with your age, with your temperament. And if your asset allocation is not right, I mean, you are bound to suffer. For example, it is just like sugar. It should not be there in excess, but at the same time, it should not be below a certain level also. If your sugar level goes below, it also creates a lot of problem. Your brain stops functioning because it needs sugar at every stage. And also excess is also not good. So balanced approach is the right thing as far as the retirement planning is concerned. So what we have done a study of 1998. If you are investing just 1 lakh rupees simply and doesn't do anything and keep remaining invested in the market, its return is 9,74,000. giving returns of approximately 9%, 10%. But if you are doing just rebalancing of the portfolio in the ratio of 60 or 70 or to 30, that whenever the portfolio value is above 70, you are selling the equities and buying the debt. Whenever the debt is more, you are selling the debt and putting it back in equity. You are getting 30% more return. It is 12,50,000. So this is the way this functions, rebalancing 70-30. If market goes up, it becomes 85-50. You sell 15% of your equity, you make it balance 70-30. Market goes down, you sell your debt, put into equity, again it goes up. This is the cycle. If you keep on doing, it has generated 12.66% return continuously since 1998. And last 22 years, we have also seen, now this is another fund which I'm talking about. There has been 3 major falls in equities, 2008, 2013, 2020 due to Corona. But we have seen that still 16.6% return is consistently generated by 60-40 approach. So my simple question is, when you are getting these kind of returns, why one should compromise these return and settle for just 25% of the return? You are getting meager 4.5% return in that kind of product. Why you are compromising this when you are already knowing that without any guarantee you are getting 16.66 return? Why to settle for a guarantee? Had there been guarantee for anything which is better than 16.66, it would have been easy to understand, okay, that might be the case for buying that product. But the guarantee is so pathetically low, then why you need to go there? Because from 22 years, this kind of approach has worked phenomenally in the markets. You don't need to worry about if there are falls in the market, there are going to be rises also in the market. So you will not get your share of bricks, but you are also going to get your share of bouquet also. So we have analyzed these kind of pattern, and we found that there has never been a year where the market has given you, any serious problem as far as your investment is concerned. In fact, it has rewarded you handsomely, and 16% return has been consistently generated. So when data is supporting, if you believe in India story, data is supporting next 20-30 years, if you think that India that belongs to India, then there should not be any second thought about investing 60% into equity and 40% into debt, that kind of solution. But don't go for balanced or hybrid kind of mutual funds. Why, we will see in the next slides. So now the same plan, what we did, if you are becoming a little bit reasonable, if you understand that, yes, okay, let the power of compounding goes in my favor, and you settle for, 60% equity in multi-cap, where you have got combination of large cap, mid cap, small cap, and 40% is in short-term bonds and debt funds, AAA rated company. What is going to happen? You see, if you are putting money just for 10 years, 1,20,000, 1,20,000, after that you don't need to pay anything. Every year return you will be seeing with just 13% return. I'm not taking higher side of 16%. I'm settling at 13%, 12.66, 13%, which has been there from past 1998 with rebalancing. What we are seeing from 11th year, you don't need to pay that 5 additional payment like that is needed in UMANG. So what we are seeing is, we are seeing that we can get 125% of the premium. First year 1,20,000, you can get 1,50,000, which is increasing at the rate of 7% inflation continuously from there. Now, if you see this, in 20th year, you are drawing 2,75,000. In 25th year, 3,86,000 per year. Excuse me. And in 30th year, 5,42,000. Still, your fund is also keeps on growing. So what it shows is that approximately 3 crores has been paid if you are getting just 13% return in the period of 50 years. And the fund value, which is left after paying 3 crores, is approximately 4 crores. So 1,20,000 you have paid for just 10 years. From 11th year, you have started getting 1,50,000, which is increasing at the rate of 7% every year, which is reaching figure of 21 lakhs when you are reaching say age of, say, if you are buying this product at the age of 30 and you are reaching at the age of 80, 85, you are getting 20 lakhs rupees per year. And still your fund value is 4 crores. So 7 crores ka payout. That comes to approximately 5,765%, because, that is the power of compounding. So my suggestion is that when there is so much benefit in getting diversified portfolio, why you should settle for guaranteed return? Now there is another version for this same thing, which we have prepared for. That was one kind of presentation. 1,20,000 paid for 10 years and 11th year 150. Now this is another set of presentation where you see, if you are paying just 1 lakh rupees for 15 years, what is going to happen after 15th year? Your fund value is reaching 41,75,328 with 12.66% return. And with this fund value, if you are really planning a pension which is going to be there throughout the year, and you don't mind keeping anything residual left, you don't want anything to be left for your nominee, you want everything to be saved for you and your wife or your spouse, then from 16th year, gentlemen, you can get 2 lakh rupees per year from this combination, and that too increasing at the rate of 7%, going right up to 18 lakhs rupees when you reach at the age of 80. Now this plan is what? It is giving you approximately 2 crores 82 lakhs in terms of payout. But there is absolutely nothing left after that, because this plan has been designed to pay you when you are staying there. There's nothing left for next generation. So this is one model. If you want something to be left for the next generation, you can, the previous one which I have shown, you are withdrawing at the rate of 1,20,000, 1,50,000. Here you are starting at the rate of 1 lakh, direct doubling your amount. For example, if you are paying 1 lakh, you are getting 2 lakh rupees, and which is also increasing at the rate of 7%. So what we have observed, if you are getting 12.66% return, which has been backed by data, which has been backed by science, by managing 60% in multi-cap and 40% in short-term duration AAA rated securities, generating 12.66 average percent return, you can beat inflation. You can have you can outperform various kind of scenes, and you can have a tremendous lifestyle. Now just compare UMANG. For example, comparing this with UMANG, if you are promoting 15 years, after 16th year, for next 35 years, you are getting meager 35 lakh rupees, 1 lakh, and you are getting 1 lakh back, same amount. But here you are getting 2 lakhs, which is increasing the rate of 7%, is getting 2 crore 82 lakhs, which is almost 9 times of the payout given by UMANG. So 9x, 10x amount, if you are ready to open your mindset. So the tariff features of, this thing, ULIPs, we are going to convert. Now, this is a plan which I suggested. Now, it has got a lot of advantages associated with it. Now, in UMANG, you will see the life cover is increasing daily. From the day one, we are giving you 7 times risk cover than what UMANG is giving you. For example, if UMANG is giving 15 lakhs, here the cover will be 1 crore. Accidental 15 lakhs, here again accidental will be 1 crore for next 40 years. Additional critical illness, which is not present over there, for 20 lakhs. For example, if there is any major illness, after 20 major illness is detected, you have paid only 15 lakhs rupees as a premium, and only one claim of critical illness, 20 lakhs rupees, will be, sufficient to pay you back whatever money you have given. Whatever insurance value is there, that is additional. If suppose death happens after that, that 1 crore will be still be payable. And if you have taken whatever the pension, as we have discussed, from 16 years, that is additional. So that kind of power, that kind of advantages is associated with the flexibility in ULIPs. So additional hospital cash 10 lakhs. On every hospitalization, you will get 0.5% of the sum assured. If our sum assured is, say, 1 crore, you will get 5,000 rupees on daily basis. In ICU, it is 10,000 rupees. Up to 10 lakhs, that is payable. So hospital cash is almost, say, 70% of your total premium paid. So this is the fourth benefit. So now the flexibility, just 5 pay, 6 pay, 7 pay, whatever amount you wish to pay, you can pay. Rest can be, if the returns is good, the way the equity market is performing, I mean, even 10p is more than adequate. Now, 6th year also you can withdraw your fund 100%, leaving in case if you want, you can withdraw 100%. If you don't want, 150% you can leave and balance you can withdraw. So these are the advantages of this plan. Now, among the life cover is just 1/6, exceed 1/6, no critical illness, no hospital cash. Minimum you have to pay 15 pay. You cannot take any break. Here you can take break in ULIP. No access to 95% of fund. That is the biggest advantage of the UMANG kind of product. You will be growing that money just for the sake of your beneficiary. That money will not be of your use. If you want to use it, you have to break the policy. That is not. There's no power of compounding feature. Flat payout, no access to 90%, no liquidity. If you need any fund, you have to take it as a loan. Minimum 15 pay, no control over funds. You cannot decide where you have to put money. If there is a fall in the market, if there is a crash in the market, I have got this facility of 40-50% which is lying in debt fund to deploy in the market and to get benefit from it, because I know these prices are not going to come back. But this is not possible with UMANG. There's no rebalancing facility. So here is an infinite banking concept. If this money can grow like that, you can take a loan from that, you can pay back to that. There's no need to go to bank. Okay, so this switching and rebalancing is the huge differentiator which is associated with the which people are not recognizing. That is the purpose of making this video. Don't be blind to any kind of guarantee. You are making yourself slave if you are taking to any guarantee. Now, this is the performance of a typical ULIP. If you see, they have consistently outperformed the market, and they have got various funds. And if you take the balance combination of any funds, you will see that minimum 14, 18, 20% return they have easily generated in equity schemes, and since 2009. So there is no reason why this returns will not be generated, because they are also very quite established fund manager. They are also managing lakhs and crores rupees in their fund management. They have got 20 years of experience. They have seen market, and Indian market is performing like anything. Indian insurance market is also performing. Funds are keeping on coming on everyday basis. So there is no reason why you should be afraid to put money in ULIP. That is what I want to say. So this is another feature which, as being a professional trader, we can offer you these kind of services, because ULIP is a product which is 90% of fund management and only 3 or 4% of insurance. Now, what people do normally, they buy product from a person who doesn't have a required knowledge and experience of the equity markets. So what happens if they take the money and they invest at the peak of the market, and the market comes down, the fund value comes down, and the investor becomes angry over them. But they are basically in the sales job. It is their job just to get the products being sold and being pushed to the customer. But how to manage that fund, it is not their lookout, because somebody who can manage the fund, who sits in front of the terminal, who has got the wide experience of the market, who has seen every stages of market, big huge rallies, who has seen bear markets, who has seen bull markets. So those persons who has got familiarity with the markets, they understand the market dynamics. These persons are the right person with whom you can park your money in ULIP. Otherwise, what will happen? You can end up in making a lot of losses in ULIP. Now, how we will do rebalancing? Rebalancing, normally we used to do for a small amount, we'll do once in a year. But as the amount becomes bigger, we'll reduce the duration from 6 months to quarter to month. And even, for example, if there are 2.5 crores and above, we will be doing rebalancing in a week. But it is not needed once in a month. If the corpus is 1 crore and above, if you do once in a month, that is more than sufficient to prevent any kind of major breakdown or this thing in equities or market. So market is not always good for buy and hold strategy. This is again, now we are sharing from our technical angle point of view, that now the market has turned a little bit bearish right now. So what we will do, we will be on wait and watch strategy until unless market goes above 18,000 Nifty and 62,000 Sensex. Till then, we will not be investing anything in the market. This is our view. So what we will be doing only 25% of money we will be investing in equities. Balance 75% we will be keeping in debt, because we know that market has risen quite sharply in past few months, and the chances of growing up are now lesser and lesser. So this is how, now this is the Elliott wave analysis which we have done on Bank Nifty, and we can clearly see that Bank Nifty may come down because of various inflation reasons or because of RBI raising interest rates and all other things. So we will be keeping powder dry to deploy at when the market gives us very attractive levels. So why you need guarantee when the past performance is so good and robust? When returns without guarantees are almost 10 times in the guarantee, so decide wisely. So risk management and discipline of asset allocation ULIPs is very important for large sum, and after 5 years, if you are running ULIP and as a trading account, you can have 0 charges. 6th year, you can withdraw all your gains on daily, weekly, monthly basis as frequently as they come to your corpus. So even if you are not long-term investor, if you are thinking of just 5-6 year terms, I mean, the kind of saving what you will have in ULIP is mind-boggling. I mean, I can tell you one thing: if you are having account with any nationalized broker, and if you are having your stocks, and if you are doing active trading to generate additional returns, you will be saving lakhs and lakhs of rupees on monthly basis if you are parking that money in ULIP. But don't do it with any normal advisor. Do it with an experienced one. Do it whose function is fund management, whose job is fund management, whose job is not to sell any product, whose primary job is fund management, who knows how market works. And if you give him the money, he can give you tremendous returns on monthly basis without incurring a single rupee, because whatever the charges are there in ULIP, they are deducted on a yearly basis of just 1.25%. And after that, there are no other charges. So we can have infinite switching between debt and equity, debt and equity, debt and equity. You can never lose money because the brokerage is not going to be there. But in broker section, if you are even having account with discount broker, there can be tremendous amount of money outgo in taxes, in STT. And as far as mutual funds are concerned, there will be short-term capital gain 15%, and if you are holding over 1 year, then 10% long-term capital gain. And as we know, finance minister has clearly told that India's long-term capital gain tax is quite low compared to worldwide, so it is bound to increase. So this 15% you are going to save in coming days. Suppose if they raises to 10 to 15% or 20, whatever I don't know, but that long-term capital gain tax you can easily save if you are putting your money in ULIP. Why? Because up to 2.5 lakhs rupees of investment, there are no taxes on ULIPs. Only about 2.5 lakh taxes there is capital gain. But again, that is very nominal. I mean, that you cannot escape if you are getting returns from the market. So saving on STT, saving on brokerage, saving on capital gain is huge in ULIPs. So financial freedom is awaiting you, gentlemen. Financial freedom is available to those who learn about it and work about Robert Kiyosaki. And this is what our magic plan says. You just, open the tap and relax. There is no holy grail in investing, but if you do simple things, with long-term discipline, right financial behavior, consistency, you can make wonders happen. Magic plan is nothing but simple plan that beat odds with simplicity, consistency, and built with power of compounding. What I mean to say in this plan was that if you're planning for retirement, something you want income for 30-35 years, please do have a dash of equity in that. And if you do rebalancing with that, there's no product which can beat that particular returns over the 35 years period of time. So equity is a must. There will be period of drawdowns. There will be period of lesser performance. So don't worry about it. Think about the time when the market is going to reward you handsomely. So it is not possible if you don't have equity at all. So don't shut the door to equity by buying a product which just give you 4% return when the inflation is 7%. That money will be too inadequate for you to serve in your retired life. So you need a product which gives you flexibility, which you give choice, which you can withdraw as and when you need. So think about it. So that was the whole purpose of my presentation. So gentlemen, if you have got any query, please feel free to contact me. If you want your mutual funds investments, advice on mutual fund investment, if you advise on PMS, if you want advice on, options. And we do regular teaching to our customers, and we provide a lot of valuable insights as far as market is concerned. So my number is 975-429-2575. My email is r@gcfp@gmail.com. And if you like this video, please subscribe to my channel. You will keep on getting a lot of information, useful information, as far as retirement is concerned, as far as wealth management is concerned, and wealth creation is concerned. Thank you, gentlemen. It was a pleasure talking to you. Bye. Good day. Jai Hind.